Good evening. Good evening, everyone. Welcome to Money Mindset. Just waiting for a couple to come on before we get started and bring on our presenters for tonight. Good evening. I see some Facebook viewers coming on. Good evening on Facebook. Please share this live. Once you come in, please share it. We have a lot of good information on tonight that we're going to be sharing. I see some YouTubers coming on. Good evening, YouTube. Good evening. Please share this live as you come on. We're going to be bringing our presenters on shortly. Hope everyone had a good day. Hope you're having a good evening. You were in for a treat tonight once again. Again, we have our wonderful presenters ready to present on tonight. Hope you have your pen, your paper. Get ready to take some good notes. For those who have questions on tonight, please type them in the chat. Most of all, please share this live. You don't want to miss this information we're going over tonight. We are in week 2 of our Money Mindset online seminar. I see some more YouTubers coming on. Good evening, YouTube. Facebook. All right. I think it's time to bring on our presenters. Okay, again, my name is Shirley Herring. I'm so glad you tuned in on tonight. This is week 2 of our Money Mindset seminar. And we have our 2 presenters back on tonight. So first, we are going to bring on our first presenter, Mrs. Fia Brown Jean-Pierre. I'm going to just turn this off. Okay, Afia. Bear with us 1 minute because I'm trying to look for my presenters. Okay. There she go. Hello, Mrs.
Hello.
I'm like, wait, where the presenters at?
We here.
All right. And next, we have none other than Mr. Ed Sanchez.
Woo-hoo!
Good evening.
How are you both doing on tonight?
Excellent.
Excellent.
We're doing well. Congratulations to all the ladies on their celebrating their Women's Month.
Yes.
Listen, encourage you to get financially literate because statistically, you will be handling the money because y'all outlive us.
Oh, wow. Okay. Okay. Well, it is. I'm so happy to have you both on again tonight. And last week we had a little intro by Afia. We're going to go through the same thing tonight. Afia, introduce yourself. And then we're going to have you to introduce our presenter on tonight, Mr. S. And then I'm turning it over to you guys, and I'm gonna go to sleep. No, I'm just kidding. I have my pen and paper, so I'll be taking notes. And again, I advise you pen and paper. Take some notes on tonight. It's gonna be a great night. All right, Sophia, it's on you, dear.
Okay. All right. Okay. Welcome, everyone. Thank you, Shirley, again. Thank you to your team. Thank you to There Is Hope Outreach Ministry. We are totally so excited because we're back, y'all. We're back, y'all. Yes, we are.
You have to love her. You have to love her.
Yes, we are back by popular demand. What? Okay, so thank you to all of you, the audience who was here with us last week. Thank you for returning. And thank you for our new friends, the ones who are here today. Thank you. We're gonna have amazing content for you, like we did last week. So we're so excited and we're ready to go. So those of you who are here, if you can just type in hello in the chat so that we know that you're here, that would definitely be awesome, because this is Money Mindset Financial Literacy second session. Yeah. So why are we back, right? We are back because of you, audience, right? Because after our first amazing session, Shirley had received a plethora, and I use that word when I can, plethora of questions, right? So it's like, okay, so we must gather these questions and make another session to accommodate those who would need their questions answered, right? So like I said, be sure to tell a friend, say hello in the chat and tell a friend, because we're going to keep going and growing in this whole environment, right? So if you did miss the first session, it was a powerhouse. It was a powerhouse of good financial overview, right? The information was amazing, right? So I urge you to contact Shirley or me or both of us for the replay. So make sure to contact us for the replay so you can see it, because it was an amazing overview of financial literacy, right? So let me quickly introduce myself. My name is Afia Brown John Pierre, and I am financial planner. I do life insurance for New York and North Carolina, and I'm also a fully licensed securities agent. Yeah. So me and my wonderful husband, Aaron John Pierre, we just rocking and rolling in this financial service business for a while now, and we just excited to service individuals and families. So enough about me. Okay. So I have to introduce to you Ed Sanchez, and he mesmerized everyone last week, right? Right, Shirley? Like, he was just blowing minds and dropping bombs, right? And putting it in layman's terms, so it's truly understandable, right? So we so appreciate him for that. And so in gathering your questions, be sure, like Shirley said, to have your pen and your notepad ready. Yes, yeah, exactly. Don't write it down, and then he says something else that's, you know, mesmerizing and magnificent, and then you done miss that. So be sure to write your questions down so you can type them in the chat, right? And so it gives me the utmost honor to present to you our financial advisor, Ed Sanchez. Take it away, Ed.
Thank you, ladies. I was teasing about the Women's Month, but it's actually true. A lot of my clients are females, and it's important that females as well as males, you know, get financial literate, because, you know, a lot of, you know, most families are two-income families. You know, statistically, you know, women outlive by men by 7 years. So it's important that you get a handle on what's happening with you financially. So and congratulate the women on celebrating their month. Okay. And, you know, as believers too, we're entering Easter season. So I wish you guys a blessed week. You know, we got Palm Sunday coming up, and what a lot of people call Holy Week, and Easter coming, which represents, you know, a lot of good things for those of us who believe. So it's a good time. It's a good time of the year. Spring, you know, delayed. I don't know what happened. I think we moved the clocks up too fast, because I think we just went back into winter. So hopefully the weather will be better. So those of you who celebrate, you know, Palm Sunday and Easter, you know, God bless and enjoy those days. Okay. So last week we covered a lot of things because we wanted to show people that it wasn't going to be one dimensional, that we were going to cover a lot of different things. We were able to answer most of the questions after what we did. And then, of course, with the replays and things that happened during the week, Shirley fielded some more questions. So today we're going to focus on just one topic. But what we're going to do is I'm going to go over like 3 of the top things that Shirley during the week was asked about was the Roth IRAs, credit repair, and Social Security. So I'm going to hit a little bit on that because we want to be responsive to our audience. So I'm going to hit a little bit about that, and then we'll cover today's topic, and then, you know, we'll do some Q&A. Okay. So, and of course, you know, on the bottom right, you have Afia's contact information, because what happens is sometimes you give me a question, right, and I'll answer it, but that might generate another question, but we can't do it like this. So if you have a question and I answer it, it might generate something, you know, contact Shirley, contact Afia, and then we can. So what we'll probably do is, you know, we'll do some Q&A today, and then we'll start off with a couple of answers from questions that came afterwards, and we'll try to service you, you know, as much as we can. So some questions came up about Roth IRAs. Roth IRAs seem to be popular now because it allows you to save some money tax deferred. Most of us are, you know, if we're saving through if most of us are saving through, let's say, through our jobs, through a 401k, that money is put into your retirement plan before they take taxes. So it's what they call pre-tax. So if you make $1,000 a week and you put 100 into your 401k, you're only paying taxes on 900. That 100 that goes into your account, it doesn't get taxed. It grows tax deferred. And then, you know, later when you retire, as you withdraw that money, you pay taxes because that money was never taxed. Okay. Roth is a little bit different because Roth IRA, you're putting after tax dollars. Okay, so if you using that same example, if you make $1,000 a week and you put 100 into a Roth, you're going to pay taxes on the 1,000. You're not getting the tax deduction on the 100. Okay, but that money grows and it grows tax deferred, and then when you go take the money out, it comes out tax free because, you know, you had already been taxed on that money. Now, obviously, there's a few nuances to it. I'll try to hit a few of them, but like I said, if you want to have a more specific conversation, you can, text or email Afia on that. Okay. Now we know in the IRA rules, right? You can't touch the money till age 59 and a half. If you take it out prior to 59 and a half, you pay a 10% penalty. Plus you pay taxes if it's a 401k or traditional IRA. The Roth is a little different. And the Roth, if you take the money out before 59 and a half, if you only take out what you put in, you're not paying a 10% penalty. So let's just say you have put $5,000 in your Roth and it grew to 6,000. If you took the 5,000 out, you're not paying any taxes. You would only pay taxes on the growth. You would only pay on the $1,000 that it grew. Okay. Now, if you wait past age 59, okay, then what happens is if the account has been in place more than 5 years and is after age 59 and a half, what you put in and the growth is not taxable. So if you take it out before 59, the growth is subject to taxes. If you wait till after 59 and you've had it more than 5 years, then everything is non-taxable. Okay. So just so you know, I was going through some stuff. Let me share in like the traditional IRAs that, there are some exceptions. Let me give you a few exceptions. Like if you have an IRA and you needed to take money out, okay. First time home purchase is an exception. If you get a disability, that's a potential exception. Okay. If you have a abnormal medical expense, you might be able to get that. Those of us that went through COVID, remember people who took their money out during COVID did not pay the 10% penalty, but that was a big problem because everybody heard, oh, no penalty. So they took out a lot of money during COVID, but they forgot, oops, what about the taxes? Right. So the 10% penalty was waived, but the taxes were not waived. So a lot of people got hurt on their taxes when they withdrew money during COVID. Okay, so so once you determine whether you want a traditional or a Roth, then you gotta decide what kind of portfolio you want. And what I recommend is that you have something to diversify. As a matter of fact, I'm going to read a Bible. I'm actually going to read a couple of Bible verses for you today. Okay, is that okay? So the first one that I'm going to read for you is in Ecclesiastic chapter 11, verse 2. And I'm reading from the NLT version. Okay. So you know what it says? But divide your investments among many places, for you do not know what risk might lie ahead. That's in Ecclesiastes 11:12. So way back then, they knew diversification was the way to go. Our parents always say, what? Don't put all your eggs in one basket, right? Okay, so any kind of investment you want to diversify. Okay, if 2 verses down, okay, if we go to verse 4, it says, farmers who wait for the perfect weather never plant. If they watch every cloud, they never harvest. Okay, so a lot of people say, oh, when I start making more money, I'll invest, or when this happens, I'll invest. No, you gotta start. There's never going to be a good day. Okay, there's never going to be a better day than today. So get started and you can take some baby steps. Does that make sense? Okay, another question came up about credit. Okay, now I'm not a credit counselor, okay, but I had to work on my credit just like everybody else, right? So what if you haven't signed up for Credit Karma, it's free. I suggest that you do that. Okay. Just so you know, they passed a law years ago where you're allowed access to your credit report once a year and it's free. Okay. Now I'm going to give you the exact one because there's a lot of, when you Google free credit report, you get a lot of them that say free, but they're not free. They're free for you. Okay. Okay. This is the official one. and I'll spell it out. So probably Shirley could put it in. Okay, it's annualcreditreport.com. That's ANNUALCREDITREPORT.com. So it's annual with two N's, annualcreditreport.com. That's the legitimate one that you can go and get your credit report, because, right, that's your report card. If you want to improve your credit, let's see where, let's look at where you start. Okay, so I took a couple of notes from my credit report, actually not my credit report, but from Credit Karma, and basically I'm gonna go over a couple of things. I'm gonna list a couple of things that have high impact on your credit score. Okay, number one high impact is your payment history. If you have a history of late payments, that's a no-no, and that's high impact. So that will affect your credit more than other things. Okay. Number two, credit card usage. Credit card usage is also high impact. So if you're using more than 30% of the credit you have available, so if you have 10,000 in credit line and you're using more than 3,000, that has a negative effect, and it has a high impact on your score. Okay. Number three of high impact is derogatory remarks. That's why you need to check your credit report, because if there's something there that's not correct, you have to. I know that there's means through Credit Karma that you can take that off, but like if you have a lien or something, okay, that has high impact. Okay, so those are the three things that have the highest impact. Now, medium impact is credit age. So the longer you have credit established, the better it is for you. So if you have some credit cards and you decide you want to cancel some, don't cancel the long, keep the one that you've had the longest, because that's gonna add to your years of credit. So that has medium impact, the age of your credit. Okay. And then low impact is the amount of credit cards you have. I mean, some people have a few, some people have a lot, but that's not a big impact. It's just, if you have a lot, then just make sure that your total amount, right? If your total amount is, so I know people that have $100,000 in credit cards, then you got to keep that under 30,000. So the amount of cards doesn't affect it too much. Okay. But if you only have a few, remember, and you pay it off, it might not be it's probably a good idea to still keep it open, because that keeps the amount of credit, it keeps the number up for what you have available to, unless they're charging you crazy annual fees or something, but okay. Another thing of that, and this is the last one, but this is also low impact, is hard inquiries. So if you apply for a loan, if you apply for a credit card, okay, sometimes if you're trying to get something, ask them, is this going to be they usually tell you, yeah, this is going to be a hard inquiry. Okay. Because if you have too many, it's a low impact, but it does have negative if you're applying a lot. Okay. So that work on that. So now, if you're shopping around for a mortgage and they do a lot of inquiries at mortgage companies, that usually doesn't have a negative effect, because they know you're shopping around for a mortgage. So you might do 3 or 4 like within a month. If they see it's with mortgage companies, they know. Okay. So credit. Okay. Last thing was Social Security. I'll talk a little bit briefly on that. Okay. If you're in your 50s, you probably should, go on the Social Security website and try to get an idea of what your projected monthly amount would be. This way you kind of have an idea. Obviously, the younger you are, the more of a chance that it'll grow, but at least as of the time that you order it. Okay. Now, some people wait till full Social Security age. Some people want to take it early. The earliest right now that you can take it is at 62. Okay. So in some cases, it's beneficial. In some cases it's not. I'll use a couple of examples. Okay, so if you're 62 and you're not planning on working, or you're going to work part-time, then it might benefit you to take Social Security early. Okay, the reason why I say that is, let's just say I have a client that's 62. If they wait till their full retirement age, which is 67, they'll get about $400 a month more. Okay, so she would say, well, maybe I should wait. I'm saying, but if she's not going to work, and if she's not working part-time, then those 5 years that she waited by not taking the money, it would take her 10 years to get that money back. You follow? Because she gave up 5 years of Social Security checks. So that extra $400 that she's going to get later, it would take her 10 years to make that money back. Okay, now, if you're working, you shouldn't take Social Security early, because now, so if you're on the borderline, depending on what your age is, every year it changes, find out what the penalty is. Right now it's about $20,000. You're allowed to make about $20,000 as of last year. So if you're going to make under $20,000, it doesn't affect your Social Security benefit. But if you go over whatever the cap is, you will be penalized $1 for every $2 you took. So if you went over by $5,000, they will penalize you $2,500, and that could result in you not getting a Social Security check until that $2,500 is paid back. So those are kind of like the general rules. Okay, obviously once you turn 65, you automatically qualify for Medicare. Okay, and depending what your situation is, if you're still working, you're still covered through your job plan. Some people's unions will cover them for the rest of their life. So you may or may not need Medicare B based on your individual situation. Okay, but if you do need Medicare B, okay, they have Medicare supplemental plans, which you see a lot of those being advertised on TV. Okay, so just know that every year between, I believe it's November, I think October and November, that's called an enrollment period. So obviously if you're 65 and you don't have a plan, you can get one. But if you already have a plan, then every year there's an enrollment period where you're allowed to shop around to see if you can find a Medicare Advantage plan that's better. So you might be with Humana during the eligibility period, the enrollment period, you can call up and you might find out, hey, you know what? U.S. Healthcare, it better fits me, because each plan works differently depending on what doctors you see, what medications you take, things of that nature. Okay. If you have any questions too, you can refer that to Afia, because we have a company that we deal with that their Medicare, bro. In other words, they will walk you to all the plans available in your zip code and help you choose the plan. So it's not like we're going to tell you call Humana. We're going to say, no, call this place because they are familiar with all the plans in your area and they can coach you. So we have a company that does that, and it doesn't cost you anything. It just costs you a half an hour of your time, because they will ask you questions pertaining to what doctors you see, what medications you see, and then they'll determine. In my case, U.S. Healthcare was the best for me because my doctor was already with them, but there was other plans available. So that's kind of a little Social Security, Medicare. Okay, so that's kind of a little recap on some of the questions that we got before, because we want to cater specifically. We don't just want to hear talk about what we feel is important. We want to respond to those of you who are listening. Okay. And we'll do the same. Okay, so now we're gonna go. We're gonna if Shirley can bring up the PowerPoint, I'm just gonna go over a few slides with you. If you're on your phone later on, you could probably see the broadcast, but I'm gonna read the slide so you'll be able to. Okay, so we talked about building a financial house last week. So I figured I'd put this little picture to kind of make it They say, what is it? A picture is worth 1,000 words. Okay. So here's your house, but this is a completed house. Most of our houses are not completed. Most of our houses are still under construction. All right. But we all know that we build a house from the bottom up, right? So we talked about the foundation being income protection, right? We talked about after that, emergency savings, asset protection, retirement planning, and then other specific goals like any large purchases like houses or vacation homes. Okay, so that's the fundamental. All right, so what we're going to do is in the next series of classes, we're going to go through the different stages of building, and of course we're going to start from the ground up. Okay, so today we had gotten a few questions about life insurance. So today we're going to talk about the foundation. We're going to talk a little bit about life insurance, the different types of plans that are out there. Does that make sense? Okay, so let's go to the next slide, right? Which is, I'm sorry, is the one right after that. And then after that, Shirley, I'll tell you the number of the slide, because after this, there's only going to be 3 more slides. Okay, so go to the one that has, I'm sorry, the second one, the one that has the picture of the house. Yeah, right here, right? Oh, yep, I'm sorry. The one with the house, the car, I believe it's, and the tree. Yeah, right? So remember we talked about this way. What if I showed you this, your house, your car, and your tree, and I asked you in what order would you insure these items, right? Most people will say the house first, the car second, and the tree third, right? But if I told you that tree, right, every 2 weeks, the leaves turned into dollar bills, you probably say, wait a second, I think I better insure that tree first, because that tree, gives me money every 2 weeks, right? And we use that example because guess who's the tree, right? Me and you. So a lot of people insure things that they consider valuable, and they are, but there's nothing more valuable than your income, because if your income stops, then your whole financial plan falls apart unless you have a plan B. Does that make sense? Okay, so let's just scroll down to, you're going to go down to slide number 14, I believe. No, keep going. Yeah, okay. So that's kind of the same thing, the importance of life insurance. So go to the next slide. Good. Okay. So this is how life really works, right? We call this the theory of decreasing responsibilities, right? So you're going to see a green line that starts low and goes up, and then you're going to see a blue line that starts up and goes down, right? So you take a young family, right, today, right? They got young children, they got high debt, they got a house mortgage. So loss of income when you're young would be devastating. Would you agree with that? Okay. So if you look at the bottom, it says in the early years, okay, you may not have a lot of money, right? Kids and a lot of money usually don't go together. When you're right, because you're starting, you have, okay, in the later years, you better have some money. So the green represents the money that you should have. You start with a little bit and then you start building it as you retire, because at age retirement, your children are grown, your debt is lower, your mortgage is paid. So now you're more focused on retirement income, right? So if you look at the blue line represents insurance. In the early years, you may need a lot of insurance because you have a lot of responsibilities, okay? But in the later years, you may not, right? Because if I were to ask you, if you're age 65, would you rather have a $300,000 life insurance policy or $300,000 in the bank? What do you think most people would say? They say, no, I would rather have the $300,000 in the bank because I could use that while I'm still alive. And if I pass away, my family can get that. Okay. On a life insurance policy, you can't do that. Does that make sense? So because changes in you're going to have financial changes in your life. So you should not have the same amount of insurance your whole life. You know, some people like, you know, so if you have the same amount of coverage for your whole life, chances are you probably don't have enough when you're young, and you probably have too much when you get older. So that's why sometimes we recommend term, because it lets you get the amount of coverage when you need it. Okay, so let's go to the next slide. Okay, you basically have two types of insurance, right? Now, let me just pause here for a second. A lot of people are buying these policies they call accidental death and dismemberment policies. The credit unions are known for selling these, and they're very popular because they're very inexpensive. Okay, but what you got to understand is that it's an accidental death policy. So if you die and is not the direct result of an accident, the policy does not pay. Okay, if you have one of those policies, go to the last page, and the last page has a column called exclusions. You know what an exclusion is? An exclusion is, this is when the policy doesn't pay, and you're going to see a long list of exclusions there. Okay, so the people who died on 9/11 didn't get paid. The people who died during COVID didn't get paid. If I got a heart attack while driving and crashed my car, I didn't get paid because I died of a heart attack, not an accident. Okay, so be very careful of these accidental deaths, because they're very cheap, so they're attractive. Okay, somebody told me, oh, I got this $1 million policy, I'm only paying $20 a month. I said, wow, let me see it. Guess what it was? So when I listed, it was half a page of all the exclusions. Okay, so beware of those. If your job gives it to you free, take it, but don't pay for it, because chances are you're not gonna do that. Okay, so let's talk about term for a second. Okay, term insurance, right? It's become popular, but there's different kinds of term insurance. Okay, you have annual renewable term, which is the lowest in cost. Annual renewable term is your face amount stays the same, but your premium goes up every year. Okay, a lot of the SBLI policies are annual renewable term. Okay, so you have 100,000, you're paying $18 a month, but then it goes to $25 a month, then it goes to, okay, so they get expensive as it goes along. Okay, you also have what's called decreasing term. These are popular with the mortgage companies because in decreasing term, your premiums stay the same, but your face amount decreases. So if you're paying $50 a month, that stays level. But let's say you started with 150,000, then it goes down to 140, and then it goes down to 125. So a lot of mortgage companies offer those because they're assuming that as your mortgage balance goes down, the face amount goes down. Okay, so those are more inexpensive, but in one of them they get expensive. In one of them, okay, sometimes it benefits to have a cut. Okay, now they also have level term. Level term means your premiums and your face amount stay level for the life of the term. And what do I mean by that? So instead of annual renewable, you have some that are 5-year renewable term, 10-year renewable term, 20-year renewable term, 30 renewable. Okay, so the younger you are, the longer term you can lock into. Okay, so a young family, they can lock into a 35-year term policy where their premiums and their face amount stays the same. Somebody middle-aged, they probably will only qualify for a 20-year term. If you're old like me and I'm starting, I probably will only qualify for a 10-year term. Okay, but the good thing with term insurance is you could you could buy it for the time that you need it. So if you just bought a house and you got a 30-year mortgage, you could buy a 30-year term policy, so you know that you have that amount level for 30 years. Okay. So what happens after the term is up? Okay. After the term is up, you can renew, but when you renew, okay, you're going to renew at that age, so your premiums will go up based on that age. Okay. Now, be careful, because some companies, after the term, they make you requalify medically, and that could be a problem in you renewing your term. Okay. I deal with companies that let you renew automatically without proof of insurability. So once you start as a client, even though you're older and you're renewing at a new rate, you don't have to requalify medically. So make sure if you have term insurance that you're dealing with a company that doesn't make you requalify medically. Does that make sense? Okay. So you have some people that have, right? When you're young, right, you need a lot of coverage because your kids are young. As you get middle age and your kids start leaving the house, you don't need as much. Okay. Because remember, the purpose is that the amount of insurance should be going down and the amount of your investments should be going up. Does that make sense? Okay. Now you have some policies that they have a savings element to it. They call cash value policies. You have some universal lives, you have some whole lives. Okay. Obviously, their initial premiums are higher. Okay. They include an investment component, and I wouldn't even say it an investment component. I would say a savings component. Okay. Because the challenge is right now that the majority of people that sell life insurance don't have an investment license. So they're only they're only in a position where they can only sell you a life insurance policy because they're not licensed to do the investment. So it's easier sometimes for them to sell you something like this, because for me to sell a whole life policy, I don't need an investment license because it's not really an investment. It's what they call a cash value. In traditional plans, you can receive your cash value or your life insurance, but not both. In certain plans, only you can get the cash value if you pay extra fees. So in other words, so let's just say, if you have a whole life policy, right? You're obviously paying more because they're saying some of it is going towards insurance and some of it is going towards a savings plan. They call that a cash value account. Okay. 9 times out of 10, I tell people not to get this. It's very rare where I would recommend the cash value. I'm a firm believer that your investments and your insurance should be separate. I'll explain why. First of all, there's so many administrative upfront costs that when you look at the cash value on your policies, the first few years is zero. You don't build anything and then it starts around the 3rd year. You start building some cash value, and it grows at a very low rate of return. Okay, so let's say you have a $50,000 cash value policy. You have $5,000 in your cash value. The face amount is $50,000. Okay, if you pass away, you would think that you get the $50,000 and the 5. No, the 5 is part of that. So if you pass away, you only get the face amount. You don't get the cash value that's in there. Okay. These things are popular because they tell you, oh, listen, if you need money down the road, you can borrow it. So you can borrow money from your cash value. Okay. But then if you pass away, that cash value gets reduced from the face amount. So if you borrow $5,000 and you had a $50,000 policy, okay, your family gets $45,000. So it's like you're paying for 2 things, but you could only exercise one at the same time. A funny example is you buy a pair of shoes, you get home, you open the box, there's only 1 shoe in there. Okay, so if you're paying for 2, you want to get 2. That's why we always tell people that they should separate it. So the reasons why most financial planners don't like these plans is because it takes a while for your money to grow. The rate of return is poor. If you want your money, you have to borrow it. The interest that you pay back, like when you borrow from the 401k and you pay it back with interest, the interest goes back into your 401k. And these policies, the interest goes back to the insurance company. It doesn't go back into your cash value. And if you pass away, you don't get both. So if you look at people that if those of you who follow Dave Ramsey, he always recommends term. Those of you who follow Susie Orman, you can look at her pop. She always recommends term. Okay, should you have insurance and should you have savings? Definitely, they should be separate. So let me just let me go to the next slide. This will be our last slide, just to show you kind of an example in some numbers. Okay, this looks a little confusing. Okay, but let me just show you like a side by side using the same amount of money. Okay, so on the left side, you have a whole life policy. This is somebody who's 35 years old. Okay, they're paying $123 a month. Okay, face amount of the policy is $100,000. Now, do you see the red area? That's the cash value that's growing in the policy. So after 20 years, they have $21,000 in their cash value, and after 70, when they're age 70, they have $48,000. So let's just say this particular person at age 70, if they were to pass away, they got $100,000 policy, right? They got $48,000 in their cash value. The family only gets $100,000. Let's say at age 70, they wanted to take the money out. They took the money out. It becomes a loan. So now if they were to pass away, the family gets $52,000 because they took it out of the policy. You see how that? So that's why I don't recommend these. Now let's just say, using that same monthly input, right? That 35-year-old person could have gotten a level term policy for $58 a month. And you know what the face amount is? $300,000. So what do you think is better for a young family, $100,000 or $300,000? Right? So because when you're young, that's how much you need, right? Okay, so look how much cheaper it is. 58. So now if you took that and put it in a separate Roth IRA, right? If it only grew at 3%, you would still have the $48,000, but in a separate account. So if you were to pass away, right, you would get both. Does that make sense? So if you look, it's a mathematical equation, right? If you take the money that you put in and you divide it, okay, in both ways, okay, because the goal is, when you're in your 70s, the goal is to have money invested and not a life insurance policy. Does that make sense? Because if you haven't invested, there's enough. Okay, so that's kind of an example. Obviously, there's more intricacies. Okay, now a couple of things before I wrap up, and you could take that off the screen, and because some people ask me, well, what about children? Should we have life insurance on children? Obviously, children are not breadwinners. Okay, most of my clients, I give them what's called a child rider, where we can add the child to their and I do it for a few reasons, right? And I'll just use a couple of examples. Okay, I had a client who they had a child rider, so they're covered until age 25 on the child rider. Okay, so At 22, he got married, okay, and applied for life insurance, okay. He wanted to get his own plan, okay. He was declined because he was HIV positive, okay. But because he was on his mom's plan, okay, he was able to get $125,000 of coverage because that policy guarantees you 5 times what you had as a child. So that might be a reason why you want to do a child rider. Another reason is this. We had another client in the office. They had 3 young children, and unfortunately, one of the children died. It was like, I remember the child was less than a year old. So, obviously it's not financially devastating, but it's emotionally devastating. Now, I know in most cases, if you have a death in the family, you get what, a week off? You can take a month off. You can take 2 months off, but you ain't getting paid. Okay. But because she had a $25,000 child rider, she was able to pay for the funeral and take her family to Disney and just kind of let the other kids kind of get away. And she didn't have to worry about going right back to work because there was enough to hold them off until they were able to recoup. So though I'm just telling you, those are personal stories. Now you have some of these Gerber policies that are being sold out there, and they're telling you you're going to be able to put your kids through college with these policies. That is a 100% lie. Read your cash value table. By the time that child reaches 18, you're lucky if that policy pays for the books. There's very little growth in those policies. Okay, so if you want to buy it, fine, but don't buy it thinking it's going to put your kid through college, because a lot of times they feel, no, but it's a $50,000 policy. No, that's a $50,000 death benefit. That's not $50 when they go to college. That's $50 to you if they were to die, which the chance are minimal of that. Does that, okay? So those of you who have policies, you should find out, does your policy have a waiver of premium? What a waiver of premium is, some policies have them, some policies don't. What a waiver of premium is, if you were to become disabled, the companies that I deal with, this is what happens. If you were to become disabled and the disability lasted more than 6 months, the company pays your premiums for you until you can go back to work. If it's a permanent disability, it pays the premium for the rest of your life. That's what's called a waiver of premium. Some policies have it, some policies don't. Okay. Some policies now have what's called a terminal illness benefit. What a terminal illness benefit is, God forbid, if you were to become terminally ill, meaning the doctor says you don't have that much more to go, if you fill out some paperwork and that's documented, they allow you to take some of your face amount prior to you passing away. I'll use another example. We had a client of ours that had a couple of $100,000 policy. She was considered terminally ill. There's a clinic out in Arizona that's been healing a lot of people, but they're holistic, so no insurance companies pay for it. Because she was terminally ill, she was able to take the money out prematurely to pay to go to that clinic. And as the last I heard, and this was about 5 years ago, she's still alive. So her having access to that early terminal, okay, because these clinics, they have a very good survival rate, but they're expensive, and health insurance doesn't cover it. So that's okay. So most of you probably have these, but now waiver of premiums, I think it's after age 55 or 60, depending on what company, the waiver of premium comes off. Okay, after you get to be my age. Okay, but it's something to, usually it doesn't cost you that much to get a waiver of premium. And the terminal illness benefit should not cost you more. It should be part of the coverage. Okay, so those are things to look out for in your existing policies or when you're shopping for a policy. Okay, and I'll end with this. A lot of people say, like, how do I know how much coverage I should get? You know, most financial planners say at least 6 times your annual income. Okay, we do like a full financial needs analysis, but we have a little thing that we call the DIME method, which is DIME. And D stands for debt. How much debt do you have that, God forbid, you pass away, you want to pay off? Okay. I is income. How much income would you like to replace? Okay. M is mortgage. Is there a mortgage balance that you would want to pay off? God forbid somebody passed away. And E is education. Do you have a young child that maybe you would, God forbid, you passed away, that you would like to fund? You know, so those are some of the things to, you know, that's kind of a little recap in considering maybe what the face amount of your policy should be. And sometimes it's not. I sat down with a client, they're in their mid-50s, and all they needed was a 10-year term policy because they only had 10 years left on their mortgage. Their kids were grown, so they took out a 10-year term policy. You know, young families also, like my kids, they all have 35-year level because, you know, they're all young. They're in their 30s. Okay. So I'm going to pause there. Okay. I don't know if there's any questions in the chat. Life insurance obviously is not a fun topic to talk about, but it's needed.
It's definitely needed.
Yes. Yes.
And you gave us a whole lot tonight. It was great.
That's
okay.
always.
Now, I see a quote there about Social Security. Okay.
Yeah,
now,
okay.
At age 65, you automatically should enroll into Medicare, whether you're working or not, because that's automatic. Okay. But I think that, but it's not mandatory that you file for Social Security at 65. No, you just gotta apply for Medicare. Like at 65, I got Medicare, but I didn't apply for Social Security. In my situation, you know, my full retirement age was 66 and a half, so I waited to 66 and a half. But at age 65, I had Medicare A.
Mm-hmm.
So if you're working and you have a plan through your job, you probably don't need the B. But if you might be working someplace that have no health insurance, and you could apply for the Medicare B also at age 65. You don't have to apply for Social Security if you apply for Medicare. They're two separate things.
Dennis Troy, can I start saving a saving plan with a autism or ASD adult? So he has a son who has autism. So what kind of saving plan, I guess, can he start with?
He can open up. There's several different accounts. One of them is called a uniform gift to minors, which the account will be open in the parent and the child's name. Okay, but in a uniform gift to minors, when the child reaches whatever the legal age is in a state, the parent's name comes off the account and it remains. But obviously, in the case of autism, if when the child reaches an adult, the adult can always become like a power of attorney and still be able to do that. Okay,
so
you're allowed to.
I'm sorry. The child is already an adult, so like 26, 27.
The child is already an adult.
Yes.
Okay, so if the child is already an adult, they can either an individual account and then somebody be power of attorney, or they can open up a joint account. You know, they have joint accounts. They have what's called TOD accounts, also transfer upon death, where you could assign a beneficiary. But have them send you an email, and we can do a little bit. Yeah,
Yes.
we can do a little bit more specific. But I believe that they can, and then we have to see, you know, why, you know, because yeah. But I believe if it's not going to be a joint account, then I think what's going to happen is that they would have to be assign a power of attorney.
Okay. So just email me, Dennis Choi. We have a Valerie J. Garrett. If you are SSDI and you wait until your FRA, will that amount change that you were getting while on SSDI?
I'm not really sure what FRA means. You know,
Sure, we're gonna look it up.
my understanding, if you're on SSD, I believe you'll always stay on that because it's a disability, and the benefit is higher for a disabled person than a healthy person. Like when you apply for Social Security, if you were disabled, the amount that you get is higher than regular Social Security because obviously you're probably going to need more for, you know, but I'm not, to be honest, I don't know what FRA is.
You got it, Shirley?
Okay, it's full retirement AGR. Full retirement age.
Okay.
Oh, full retirement age.
Yes.
I mean, you can double check with Social Security, but my understanding is that that if you're disabled, you get your monthly income is higher than if you're not disabled. Because I know, yeah, because you know it's sometimes gets confusing because you have SSD, then you have SSI, then you have regular Social Security. It's probably something that they need to contact Social Security to get something more specific.
Right. Sandra Davis asks, if you become disabled after retirement, can you apply for disability?
Good question. I mean, I don't. You know what? You know, I could do a little research on that. My initial reaction would be yes, but I'm not 100% sure. You know, but so that's a good question. I'm not 100% sure. My initial reaction would be yeah, because you know you're gonna, yeah, because it's a higher benefit. So if you are this, you know, obviously you're gonna have to go through applying and have your doctors fill out, but so I'm leaning towards yes, but I'm not gonna say I'm 100% sure.
All right. I have a question because I don't know why the comments are not coming through on the platform, but I'm getting texts and I'm looking at the Facebook chat. So this question is, if someone is receiving military disability benefits, can they also file for SSD or SSDI upon retirement?
If yeah. See, when it comes to that, that's not. I'll be honest. That's not my level of expertise. Most of the things that I share about Social Security is from my own experience, being 68 years old, and relearning all the Medicare. But that, you know, I would probably defer that they contact Social Security directly.
Mm-hmm.
Okay. All right. Let's see any more questions. Any more questions? Ask now. Oh, I have a question. I forgot. If you're on Social Security disability, can you earn anything outside of that? Like, say if you wanted like a part, is there like an amount you can want a part-time job or something?
I think you can, but I think there's a limit.
Okay.
So that you have to, yeah, that if you, I think you can, but there is definitely a limit.
Okay.
Because it
okay. Now this is another. I'm sorry.
No, go ahead.
Now I'm going back to the credit cards. I was writing my questions as you were talking. There's been times where my accounts were closed because I did not use my card. So how often do you have to use these cards to keep your accounts open? Because I got some good cards closed that I wanted to keep, but
normally they'll let you know. Because I got it. It's funny because I have which card was it? I had a card. I forgot which bank it was. I got an email saying, listen, you haven't used your card in a while. So if you don't use it, we're gonna, so the next thing that I purchased, I just used it. And then I got the bill and I paid it. So they usually let you know before that, because they really don't want to close it, right. So they usually will email you that. You might have gotten it and might have gotten, we get so much junk. Yeah, but that one I happened to see. Yeah. And it was a card I had opened up to get some points for something, and I never used it because like to be honest, I have about 10 cards and I only use like 3.
Right.
I have my JetBlue card because I try to build the miles. I just got an American Express Hilton, try to get some hotel points, and then my TD Bank card.
Okay.
Well, Felicia McLean advises to use it once a year. Just buy something small,
like a pack of gum.
Yeah. Don't forget to pay it, because then the interest the month.
Exactly.
Has it happened? Thank you.
Just be careful.
Yeah. The interest rates are no joke.
Okay. Someone did comment in Facebook.
I'll read one. Here's my last verse for today. Proverbs 21:20. The wise have wealth and luxury, but the fools spend whatever they get. Okay. Proverbs 21:20. So don't go crazy with them cards.
There's a reason why.
I try not to. I don't. When you're young, like you spoke of last time, everybody was offering cards when you're young and out of high school.
Believe me, because listen, the bottom line is, if you don't have an emergency fund and the car breaks down or something happens, you have to, listen.
Yeah.
Yeah. Right. So Valerie Garrett said, I did not use a card for a year and they closed it without me knowing about it. That has happened to me as well.
Yeah. So I'm thinking that some do it and some don't, No. I know it's just funny. I think it was the month before last that I got an email. So it's possible that they might have sent because they didn't send me anything in writing. It was an email. Yeah. So it's possible they might have, but because normally they let you know because they really want you to stay if you, but.
So Kervin Harris Sr., he says, what investment produces longer lasting investment if you were to receive a huge monetary gain?
Oh, did he hit that lottery that everybody's playing? No, okay. It really depends, because a lot of it has to do with how much money it is and how old you are. You know, obviously, the younger you are, the more aggressive we can be. The older you are, okay. You know, but the thing about it is, if somebody has a huge monetary gain, you know, let's say somebody sold a house or somebody got a settlement, then you don't have to be super aggressive because you're starting with a nice pot of money. You follow? I had a client that she's a cancer survivor, and they started giving all these commercials from 9/11. She used to work in that area during 9/11, but she never put the two together. And her dad kept saying, "You should call this number. You should call this number." To make a long short, the dad called the number and they sent her a thing. And last year, they sent her a settlement for $210,000. You know, she's 60 years old. She's got a decent amount in her 401k. So I don't have to put her in something super aggressive because she just wants to beat inflation. So we put her in something in an index fund, and it's doing very well. So, you know, so if you have a large sum of money, it depends on how, you know, you don't have to take as much risk as somebody who's starting from scratch.
Yeah. So Felicia,
you know, but there are a lot of different vehicles. It depends. Some of them.
No, go ahead, Ed.
Yeah, no. So it all depends on the amount and how old the person is and what. Some people want to turn it into income. There's some people that get a lump sum of money and say, how much monthly income can this pot of money give me? And we can negotiate with different annuity companies to see who gives them a better monthly payment for the rest of their life, guaranteed.
Right. So Felicia, is
yeah,
that
somebody
my girl from Woodridge? She said she had credit cards and it was closed, and she was told to use it once a year.
Yeah. Every so often, I'll pull one out and I'll just use it. Like if I'm gonna rent a car or something, just use it one.
Yeah, IRAs, stocks. I think Jean Pierre helped me purchase my home in 1999. She was born from Bricktown, New Jersey. Okay. Not me.
That was you.
What's happening?
I don't know. Oh, excuse me, this girl is. Why?
Don't start, Shirley. Come on, keep it going.
I said you gotta love her.
Just to know, there's a lot of chatter on the internet about like infinite banking and be your own bank and all that. It's a bunch of nonsense. You know, be careful. Be careful with that stuff. You know, unfortunately, I always feel that insurance and investment should be separate. You know, there's too many people out there that don't want to go out and get their investment license and do the research to service their clients better. Okay. And unfortunately, that's why a lot of them just stick to these insurance products because they're not licensed to set up IRAs and things for people. So, just somebody read it have heard varying views about having lots of money and paying off their mortgage early. Yeah, I mean, it in some cases it makes sense. In some cases, you know, to be honest, sometimes you do things for financial reasons and sometimes you do things for emotional reasons. What I mean by that is I had a couple a few years ago and they had $70,000 left in their mortgage. And when they were retiring, he was saying, Ed, should I just take the $70,000 out and pay the mortgage, you know, or should I let the money keep growing in my 401k and use my growth to pay it, blah, blah, blah. So the interest rate on the mortgage was very low. And the money that he had on his 401k was doing very well. So it kind of made sense to just take the growth and just continue to pay the mortgage. Okay. But I looked at his wife and I said, Annie, how would you feel not having a mortgage? And her eyes just lit up. I said, it would be just the fact of me saying I have no mortgage. So I says, I could say their names because you don't know. I says, Mario, pay the mortgage off. It's probably not the right financial thing to do, but just the way I saw her eyes lit up at the fact that she doesn't have a mortgage, pay off the mortgage, and it'll probably add years to your life knowing that you don't have to make that payment no more. Now it took a while to recoup the 401k because he took it out lump, but so sometimes you got to do it for is more a quality of life thing than a financial thing.
So this is a good one.
It's like my wife when she was 60 years old. They offered a retirement package. Financially, it didn't make sense for her to retire at age 60. Mm-hmm. But emotionally, after going through COVID and working in a hospital, I said, you know what? Those next 2 years that you're going to work there are probably going to take 10 years away from your life. So just retire and we'll make ends meet, you know?
Right. Good. Okay. So we have Felicia. She asks, should you use your 401k to pay off your mortgage?
Well, it depends. It depends how old you are. Mm-hmm. And remember that if you take money out of your 401k, you're gonna, if you're below the age of 59 and a half, you're gonna pay the 10% penalty plus taxes. So you could, depending on your tax bracket, you could be paying 40% on that. So I would have to know a little bit more the specifics, but initially I don't think it's a good idea. And I know some.
So another question, is it worth investing in Bitcoins and gold?
I mean, gold is a hard asset. I don't think a big part of your portfolio should be in gold, but I don't see it as investments. They have some gold funds or there's people that buy the actual bars. I mean, is a tangible, gold seems to do better when the stock market doesn't do as well. So it could be a good thing to have, like, to counter that.
Right.
Bitcoin is something that I call it, for me, this is my personal opinion, I call it casino gambling. If you have extra money that's not going to kill your retirement plan, you saw it go from 60,000 to like 26,000, and I was up to like 64,000. So you hear nobody was asking about Bitcoins a few months ago when it went down to 26, and people's portfolios were getting, but it's very volatile. To be honest, I haven't found somebody that can 100%. Ask yourself, do I know what Bitcoin is? Okay. And in most cases, somebody is telling you should buy Bitcoin because I bought it. So whoever's telling you to buy Bitcoin, ask them to explain what Bitcoin is. Most of the friends that are telling me about Bitcoin can't explain it to me. So good. I call it, I'm not saying don't do it. I'm just saying I wouldn't put my 401k, and it's funny because when it was down to 26, I almost threw the hat in, but then it just came all the way back up, and I said, so I didn't. So if you're going to invest in Bitcoin, make sure that it's something that you can afford to lose.
That's what it comes down to. Casino money.
I wouldn't put serious money in there.
Yeah.
All right, I think that's about a wrap.
Yes.
Okay.
So all I see is any more questions or topics.
Yeah.
And then what we'll do, what we'll do is the next time we'll take another subject. It might be just debt, it might be just investing in general, and then we'll review some of the questions that you're probably going to get after this live.
Yeah.
And then we'll move it forward there. Next week is probably not a good week. Next Friday is Good Friday, so we might, we might do it either earlier or later, but we'll see what day works out. I'll leave it up to the boss, Afia and Shirley.
Boss Afia. Okay, that sounds good. Well, Ed, I have to tell you, another successful money mindset.
Knocked it out the park.
You just like,
yeah, yeah.
Did he do good, everybody?
And just don't. I just encourage you. It doesn't matter where you are. Don't beat yourself up.
Contact me.
You know, all of us, if we knew back then what we know now, but it's never too late. Yeah. Most of the stuff that I'm telling you, I've lived it. I've made almost every financial mistake that you can make. I've made it. Thank God that I was able to recover it, and just trying to avoid other people, like my kids, my nephew, everybody in my family. He says, listen, I don't want you to make the same mistakes I made. So when my kids went to closing on their mortgage, and when my kids, start a new job, I review their 401ks with them, and I make sure they have the right, kind of life insurance. I say, listen, you got a new house, and all of a sudden, before you know it, you get the Home Depot card, and you're not going to get the house looking the way you want to in the first year, and before you know it, they're buying outdoor furniture and blah blah blah, and so you gotta. So I'm just trying to have other people not make the same mistakes that I've made.
That's right.
So I'm reformed.
Very good. Very good.
Yeah, a lot of that's somebody put down, should pastors inform their congregations? Yes, some of them do, some of them don't. It's a touchy situation. And I'll be honest, because I'm a preacher's kid. Okay, a lot of times the pastors are hesitant because they get salespeople that come in, and they come in and they want to sell the congregation stuff. And pastors are, so it's about educating people. But I know some of the churches are doing now, financial literacy, as a matter of fact, one day I'll have them chat with you. We have a brother in the church that's a CPA, very good testimony. I'll have him chat a little bit with Shirley, and maybe we'll have him do. I know he won't be able to be with us till tax season's over, but I can probably have Brother Chris, who's a deacon at our church, maybe do a seminar on taxes.
That sounds wonderful.
Okay, so like I said, you might have sent a question. If there's something you need, something specific, then contact Afia. If it's something she needs help with, we're here to serve. Okay, and as this grows, I was talking to Afia. If we'll see how we can better serve. Because if you have something that you need to sit down with, my office is in Midtown. We can sit down and you could bring your shoebox with the papers, and we can go through the stuff together. Or we could do a Zoom meeting. But we're here to help.
That's right. We're here to help.
Outstanding.
Yes.
Thank you both for coming on again.
You want to have us back, Shirley? You gotta have us back.
We're gonna have to have a session 3. Yes. We don't know when, but everybody stay tuned.
Yeah, and send comments to Shirley. Send comments to Shirley of stuff. And like I said, if I don't know it, I'm gonna tell you I don't know it. And I we can go back and research stuff, but I'm not gonna mislead anybody. Most of the stuff that we go over, I've either already done or I've researched, but we're not gonna know everything. But usually within a reasonable amount of time we can get some answers.
Right. Okay.
Woo! All
Thank
right.
you. We didn't do the whoop whoop tonight. Come on, Athea.
Woo!
Can I
Woo! Awesome.
Awesome night. We are going to get off of this live. We've been on 8:33, and they worked you tonight. But you handled it well. You answered every question so well in your presentation. It was always good. So thank you again. I'm so glad I met you guys. I'm telling you. We like
Yes.
family.
Have a blessed Palm Sunday and
Yes.
blessed Easter.
Yes.
You as well.
Yes.
You as well.
Yes, so we are going to sign off. Thank you, everyone, again for joining in on Money Mindset. And please share this live. Watch it over and over again. If you didn't take notes, it's out there for you to watch over again. But please share it and stay tuned for session number 3 with Mr. Ed Sanchez and Mrs. Athea Brown Jean Pierre. Did I get it?
Always. You always. Yeah.
Buenas noches.
We love you, but God loves you best. Good night, everybody. We're out of here.
Good night.
Good night.